Good morning and welcome to AFME's webinar on the future of climate risk stress testing. I can see we're up to 100 participants already, so I think we'll make a start. The session is recorded, so we will send that out to you after the discussion today, and you can catch up on anything that you've missed then as well. So thanks to everyone for joining. My name is Constance Usherwood. I'm Managing Director at AFME for Prudential and Climate Risk Management. Today we are here to talk about the report that AFME and Oliver Wyman have launched on a common path to improve climate risk stress testing and scenario analysis. You should have hopefully received this in your inbox this morning. This report provides a stocktake of the work banks have undertaken to develop internal capacity for climate risk stress testing, especially since the ECB 2022 stress test exercise. It also looks at the key challenges of that process and provides recommendations to regulators on how we can work together to improve such stress test exercises in future. The report itself is based on interviews with banks, regulators, and then a survey of 15 of our members, and this was all undertaken in the past few months. We'll discuss our findings in more detail, as well as look ahead to the Commission's Fit for 55 climate stress test exercise planned in 2024. And we also know that there's going to be further regulatory guidelines coming from the EBA in the next couple of years following the finalisation of CRD6. So today I'm joined by Radka Moscova, partner from Oliver Wyman, who helped pull the report together, Martina Spaggiari, leading on financial stability at ECB, but also here with her NGFS hat on. Very keen to hear about that. Mark Iributoya-Genya, Head of Stress Testing and Financial Simulations at BNPP. Emilio Di Maio, Head of ICAP and Stress Testing at UniCredit. And we also hope to be joined shortly by Christopher Johnson, partner from Oliver Wyman, who is also involved in writing the report. Just before we start, I want to make sure that those registered are aware of the chat function. This is where you post your questions. It's your only way to interact with the webinar hosts. We'll moderate those and hopefully we'll get a chance to put a couple to their panelists at the end of the webinar. But without further ado, we have 50 minutes and lots to get through. So I'd like to start with Radka. Perhaps you could set out a few of the key findings of our report and provide some context to our audience. Thank you.
Thank you. Perfect. And Nico is already sharing. Let me just see. Perfect. So thank you, Constance, for your nice words. And I would start with, oh, I cannot see the slides anymore. Are you able to see them? Nicole, could you please reshare?
I see them.
Can you please repeat?
I can't see them myself.
Okay.
Yeah, I can.
Okay. Perfect.
Sorry, let's try and get this up.
Yeah. Okay. Let me just start with presenting the key observations. I would not say key findings, but key observations that we had during this whole journey by interviewing both banks and regulators and surveying. I would like to set up the tone by looking at the next slide, which is the second here, and looking at the following number. As you can see, 87%. What does this mean? 87% of the banks that we spoke with and that we surveyed are running internal climate stress tests annually. And for me, this number shows the following. This shows the ambition and the proactive steps that banks are taking to address climate change. And during the interviews that we conducted together with the AFME members banks, we noted that banks are recognizing and taking proactive steps, exceeding regulatory requirements along the entire dimensions of the climate risk stress test. And to look at that, I would say, let's jump to the next slide to look at the different dimensions. What I can say is that starting with the risk types in scope of climate risk stress test, which is the first graph on the left-hand side, When asked which types are in scope of internal climate risk stress test, of course, credit risk is mentioned by almost everyone. I think 93% of the surveyed banks said that credit risk stress test is on top of the list, followed of course by market and operational risk. However, what I would like to give you is the 40% of the respondents not only are looking at the typical climate, market and operational risk, but they're also looking at further risk types such as reputational risk or liquidity risk in cases, of course, where both are deemed material. The second graph shows the number of 7%, which kinds in a way looks quite small, but this is what banks think will be the next in line risk type beyond market, credit and operational risk for the regulatory exercise. This is explicitly also triggered by the latest economic developments, as we all know, and of course by the current running EBA solvability stress test, where NII is a major point as well. The third dimension, which I would like to put here, is the portfolio coverage. So what banks are really, in which portfolios are banks looking into? The topic of portfolio coverage, and here explicitly the 20% that you see on the screen, are banks stating that they're covering more and more than already known typical portfolios, such as corporate loans or mortgages. Examples are retail unsecured, where 33% of survey banks are saying that this is deemed relevant, and also part of the internal climate stress test, and project finance even around 40%. And last but not least, I think the time horizon topic is very relevant as well, where we have banks saying that the 30-year projections are deemed relevant, of course, and it's quite helpful because they're accelerating the conversations banks are having with the strategic departments and also with the business lines. And climate risk stress test is not an adverse stress test. It's actually a sensitivity analysis, which helps also in the strategy setting, and therefore 40% are also saying that medium-term horizon can be practical, could be more practical than the 30 years projection, especially when we're looking into the planning process. And besides the pure stats that I just went through, and this is only a short extract, I would really like to leave you with a couple of key observations which are on the next slide. First of all, climate risk stress tests was a very good learning exercise conducted by the ECB last year. Of course, as the ECB summarized it, it underestimated the climate risk effects due to the scenario design, data availability, and portfolio scope. But still, it accelerated the integration within internal climate risk stress testing. Also, as shown in the previous page, banks have taken proactive steps since, and are doing so by significantly advancing in their climate risk stress testing capabilities. In the third box, you see that there is exploring a broader range of risk types. As I just mentioned, they are looking also in liquidity, RBB, etc., but not only on the risk type. They're also looking into different risk drivers. And some leading banks are already taking nature-related risk drivers and including them in scenarios. Which leads me to the next in line, which is that scenarios are the most important fact. And this is one of the key observations that we had during the interviews in the survey. Scenario design is crucial, and therefore the cooperation between the global alignment is dearly needed. And therefore, I'm very thankful that Martina is going to be the next presenter on this call, and really looking forward to hearing what she has to say. And to round this up with the last 4 points, which are here on the slide, is dynamic balance sheet provides a comprehensive understanding of the long-term climate risks. And I think that this is the way how we can tackle this, especially with terms of physical risks. And also when looking at diverse time horizon, we also need diversified approaches, which are of course depending on the materiality of the portfolios and also proportionality in shaping the climate risk stress test. As we find out, there is no one size fit all approach. So this should be very tailored. And to summarize, the last two key observations that we did, and I think that this is something that I would like to leave you with, is that climate risk stress test is an enabler for the entire organization. It is providing impulses for strategy and business, and banks are seeing this as a crucial topic also of mitigating climate change impacts. And with that being said, I would say, Martina, we would really love to hear what you have to say with your NGFS hat.
Yeah, absolutely. Thank you, Radka, for that excellent overview. And we'll come back as well, I think, when we speak to our industry participants a bit more on some of those points in detail. So indeed, Martina, obviously short-term scenarios is one area identified in our report where banks would really like more insight and guidance. And with your work at the NGFS, it'd be great if you could set out how the development of these is going and what your expectations are. Thank you.
Sure. Good morning. Very happy to be here and share some insights about short-term scenarios. And maybe I would actually start from one of the figures that Radka mentioned in her presentation, that is around 47% of the survey banks consider a 30-year horizon relevant for climate stress testing, but another 50% consider 10 years or less as a more practical horizon. And so maybe my presentation can start from the question, how do we explain this heterogeneity in views on the time horizon that is necessary? I would say because both types of horizon are necessary. Long-term horizon are very useful to assess cost and benefits of the transition. So cost of transitioning and benefits stemming from the reduction of physical risk in the long term. But short-term scenarios are essential when we want to capture also business cycle shocks, when we want to anchor our assessment to the reality and understand a bit more what is going to happen in the next 3 to 5, maybe also 10 years, because the severity that is inherent in the long-term scenario is quite limited. They are defined and designed to capture long-term dynamics, not short-term shocks. So the importance of scenario design is clear, and the importance to focus on short-term scenario now as the next step of climate stress testing is also clear. So maybe we can move to the next slide, because here my NGFS hat comes in. So the NGFS scenarios have become a global standard for climate stress testing. This has been recently proved by the results of a survey that we ran with the user community. And I'm here today talking about the NGFS because now the work of the NGFS workstream on scenario design and analysis is chaired by the ECB in the person of Cornelia Oldhausen, who is our Director General in the Financial Stability Department at the ECB. So we have a team that is coordinating and steering the work of this workstream, and we have structured the work in 5 substreams, the ones that you see here in the slide. So today I would focus in particular on short-term scenarios, which is one of our key priorities over the next 2 years, I would say. In this context, in the first phase, we plan to develop, and we are actually developing a conceptual framework for short-term scenarios, trying to understand the narratives that can be relevant, the shocks, the drivers of the risk, the transmission channels, and potential applications. And then based on this work, which we plan to publish in a note in the fall of 2023, we will start the implementation of the scenarios. This will start again in fall 2023 and will take place during 2024. And at the end of next year, we plan to be able to publish this first NGFS short-term scenarios. So maybe moving to the next slide and going a bit more into the details. First of all, why do we need short-term climate scenarios? I already mentioned it to some extent. These scenarios will be very useful to assess the near-term macro-financial impacts of the green transition and potential natural disasters, so acute physical risk. This can be helpful for central banks, private institutions, policymakers, also in assessing the economic impact that the different policy packages and options can have. We plan to be anchored to the long-term scenario framework. That's the standard in the GFS world, but at the same time, this time we need to focus on shorter horizon, 3 to 5 years. That will allow us to capture more short-term dynamics, near-term impacts, and account for shocks that have structurally a short-term impact, like cyclical factors, compound shocks in the short-term, feedback loops. We also plan to incorporate the role of expectation, preparedness, and the perception channel, which will be very important in the first years of the transition. So moving to the next slide, and just to give you some ideas on what we are currently discussing, maybe with a disclaimer that this is indeed work in progress. So the scenario names and narrative, high-level narratives that you see here will be subject to changes and prioritization in the implementation phase. So for now, we are thinking about 5 scenarios that cover different level of transition risk and acute physical risk, mainly. In the area of disorderly transition scenarios, so here we try to align to the long-term GFS scenario framework. We have developed 3 narratives. The first is a road to Paris, which is an optimistic scenario that envisages an immediate and anticipated transition that is still Paris aligned, so quite adverse and ambitious anyway, but it's smoother in the sense that it's anticipated and the right policies are implemented and are also facilitated by the spike in the energy prices, fossil fuel prices that we observed over the past year. Second is early transition scenario. It's a green bubble, a green financial bubble that is fueled by subsidies from the public sectors to green activities, and a peak in green private investments, which would overall lead to a confidence crisis in the medium term. And then we're considering also a sudden wake-up call. So we try to cover a broad range of narratives where the sudden implementation of climate policies, which maybe comes with a delay of few years, leads to an abrupt and anticipated transition. So these are 3 potential narratives for disorderly transition. And then what we can have is also the worst possible area of scenarios, which is an ineffective transition, a scenario in which policies are implemented by many countries, but they're implemented in a fragmented way, not by all. And this is not enough to achieve the temperature targets that would be necessary to reduce physical risk at global level. So a lot of investments is going in the transition, but not in the right way. And this leads anyway to an increase in physical risk. And finally, we have what we call the hotels war scenario, which would capture a general lack of global policy ambition. So current policies are implemented, but this is definitely not enough and lead to frequent and severe physical hazards. So these are only high-level narratives. So we are currently detailing a lot of details on risk drivers, transmission channels, how the modeling teams could then implement this into actual scenarios similar to what we have for the long-term framework. So moving to the next slide, maybe a few words about the next step. This thinking that I just presented, it will be detailed in a conceptual note that we plan to publish in fall 2023. And this note will be the basis for the implementation that we start around that time. We have recently launched a call for expression of interest, a public one, for the modeling teams that are interested in contributing to the work of the NGFS. The call closed last week. We are now in the selection process. So we're going to have bilateral calls with the modeling teams to understand if their skills match our requirement in terms of implementation of the scenarios. And then during 2024, we will work with the selected team or teams on the implementation of the scenarios themselves. And moving to the next slide, we hope this could have different application. The main one will be, of course, climate stress testing, understanding the impact of the transition, but also of acute physical risk, so natural disaster on bank portfolios and the financial system. Other applications range from monetary policy assessment, which requires structurally a medium-term horizon, and economic assessment as well. So here, we really hope that these scenarios will help identify the cost of this transition option and the calibration of the policy packages. And with this, I conclude my presentation. Thanks a lot.
Great, thanks very much for that, Martina. If you have any questions for Martina, please do put them in the chat function. and we'll try and come to them at the end of the webinar. So moving on from that, which is very useful insight for us, I think I'd like to turn to some of our industry participants in the report. And before I do, I'd just like to say that one of the obviously really positive outcomes of doing this report was discovering how much work banks are now putting into developing climate risk stress testing capacity internally to address what they learned through the ECB exercise. So I'd like to turn now to Mark, and perhaps you could provide some insights into that work that you've done, especially in relation to scenario development, data, proxies, and how you think that might feed into the future supervisory and internal stress testing that's on the horizon. Thanks.
Yes, hello all. Thank you, Constance. We go on the next slide. Banks and supervisors strongly believe that with internal and regulatory stress testing on which banks have worked since the 2008 crisis, we have a sound basis on which we can leverage to get assessments of the materiality of these new risk factors, both physical and transition climate risk factors, enhancing scenarios that are today mostly with macroeconomic drivers to extend the list of variables and cover these new matters that will gain in importance in the upcoming years. The objective of these exercises, both for internal risk management and for supervision, is clearly to understand how the combination of macro risk drivers and climate risk drivers play on traditional risks of institutions, notably credits, but also market, operational risk, and reputational business risk of the institutions. So if we go on the next slide, we still have significant challenges today. Top of list clearly is data, with data gaps on which we are actively working, both internally, but also hoping to leverage CSRD with an expectation to get publication by corporations on their emissions as of today and their roadmaps going forward, and be able to leverage this sound data from corporations. We also, and it has been just mentioned, we also have a lot of challenge around scenarios. We need to have sufficiently detailed scenarios to be able to link our models, either for credit, operational, or market risk, for example, to the scenario itself. So we need notably to get sectoral information, but also key information around how the energy mix on the various countries, regions on which we operate will evolve in the upcoming years, and get also the capital expenditure that we can expect to fund and to also see in the balance sheets of our clients to achieve the transition. We also need to have plausible scenarios in running climate scenario analysis. Keeping a severe but plausible scenario is a key feature, and we need to have that both for short-term analysis, notably in planning exercises, but also for long-term analysis when we assess more in a strategic thinking way how these evolutions can play on the sustainability of the institutions. We have a lot on modeling to do, even if the past crises with both COVID and Ukrainian war significantly prepared the banks to handle transition risk. We still have a lot to do around physical risk, which is new for banks, and is something on which we start to have approaches, but there is still ahead a lot of work to do, and potentially not only within the banks, but also potentially with some external partnerships belonging to the world of insurance or reinsurance, where there can be quite relevant competencies on these matters. And that relates to resource matter, where for these new risk factors, there is a challenge of finding both competencies for modeling the risks, but also totally aware of climate challenges, and this hybrid competencies is not always easy to find on the market. And so we are notably working on training our teams, having a ramp up of quant teams to these new matters, to get sufficient staff to handle our roadmap. Then there will be also a challenge around communication. For these climate scenarios, we have a lot of different stakeholders that are interested in these exercises. And so setting up the right communication to address the expectations of these various profiles is something we are working on, and notably supervisory exercises such as ECB 2022 are also a good test on how the market reacts, so different stakeholders react to detailed communication on this type of analysis. And we have to prepare communication that could be done at the institutional level, which will be much more demanding in terms of handling the market communication. To finish, it has been said, but in our horizon, we have it's the next slide. We have three main deadlines. The first one is driven by local supervisory exercises. We have notably Hong Kong with a climate stress test that is being run end of this year and beginning of next year. The European Commission Fit 55 plan will be normally notably around data quite demanding for the institutions. So we have to get instructions on that and get prepared for it. And we have a deadline, which is end of 2024 from SSM to have a fully ramped up risk assessment framework for climate and environmental risk factors. So that's all for me.
Great, thanks very much for that overview, Mark. Lots still to do and some tight deadlines to get it done by, but I think this is going to be an iterative process for sure. Turning now to Emilio, obviously the scope of the report was very large, and it'd be great to get some insight from you on the scope and the nature of these exercises. In fact, talking about the dynamic versus static balance sheet approach, the portfolio coverage, and perhaps even touching on Pillar 2 risks. If you could set out some of your thoughts there, that'd be great. Thank you.
Yeah, thank you very much, Constance, and thank you for the invitation. Very, very pleased to be here today. Yes, as you said, I mean, I will guide through some deep dives on the insights. Some of them we have already tackled. So maybe let's go to the next slide to tackle the first point. Is the, of course, balance sheet evolution, which is very important in this context. The ECB expectation in this respect is to assess, let's say, the institution exposures also going forward. In this sense, as a result of the survey that we have done together, members believes that the static balance sheet approach is very useful for short-term scenarios and also, let's say, internal purposes like the planning, for example, while the dynamic balance sheet approach is more appropriate for medium and long-term assessment in order to clearly assess the severity and the plausibility of the climate shocks. However, an important result of the survey is that it is very difficult to obtain a purely quantitative dynamic balance sheet for such a long time horizon. This is very important to be stressed because, of course, it's very difficult to predict how it will look like the balance sheet of the bank in 20 years or 30 years horizon. So that's why members also suggested to use adjustments in this context, as well as qualitative consideration. And in this sense, it will be key when running the internal stress test exercise to consider exposure reallocations, for example, in alignment with the bank's internal strategies. And this will also, let's say, improve the reliability of the results because it will help to focus really on the climate risk effects while sterilizing, for example, the effects of new volumes, which are mainly driven by macroeconomic evolution. Next topic in the next slide is the, let's say, are the risk types in the scope of the internal climate stress test. Here, the ECB expectation is to see not only the current, but also the future impacts on a variety of different risk areas. According to the survey, what is clear is that, as we have already said, credit risk is considered the main transmission channel for this risk, while market and operational are the second and the third. And also, let's say, the expectation is that for the next regulatory climate stress test, the focus will always be on around, let's say, these three main risk types. However, in the context of ICAP and the internal climate stress test, it will be very important to start considering also the risks belonging to the so-called economic perspective for both short and long-term assessment. The economic perspective, indeed, for its nature, let's say, is the natural candidate to look into such risk for especially the long time horizon of realization. Furthermore, it has to be expected also a progressive extension towards a full coverage of risks. So not only Pillar 1, but also the Pillar 2 risks like business risk and real estate being also next in line in order to understand which are the risk types which are mainly affected by climate risk from an internal perspective. Last point to be tackled is the concept of the materiality threshold. This is according to let's say the vast majority of the members very important to incorporate these thresholds in order to focus on the most impacted portfolios. This is very key also in light of the data limitation that we are facing and that we also discussed. And in this sense, to have a materiality threshold could, let's say, drive the assessment and differentiate the methodology under which to assess different kind of portfolios with different deep dives, like granular, non-granular, or macro industry driven assessment versus single name assessment. And this is also, let's say, reflected as part of the ECB expectation. Therefore, to conclude, in this respect, this could be useful also to assess specific transmission channels, which are, let's say, relevant for specific portfolio, like flood event for real estate collateral values, or other specific acute event which are impacting only, let's say, selected industry. This will be key to, let's say, focus, as I was saying, on the most relevant portfolios. And with this, I have concluded. Thank you very much for the attention.
Great, thank you very much for that deep dive, Emilia. That's really helpful to understand. Finally, I'd just like to quickly return to Oliver Wyman colleagues. I don't know, Radko or Chris, if you wanted to pick up on this, but I think one area you really helped build out in the report was the way that banks were using stress testing, and you've seen some of that through what Mark and Emilia have just set out. It'd be useful if you could maybe provide some insight, in particular in relation to how they're using it in relation to their net zero targets. And then somewhat an elephant in the room in this is how the results could potentially feed into credit provisioning eventually. For example, even considering taking account of IFRS 9, what would be your key takeaways in this respect?
So I think at the moment we would characterize how climate stress testing is used as really at the moment it's used to inform and calibrate other metrics and decision-making processes rather than being the ultimate measure itself in its own right. And what do we mean by this? So just to give a few examples. So while there are a small number of institutions who might have a climate risk stress loss as a risk appetite metric, what we're predominantly seeing is people using the climate risk stress testing to calibrate an exposure metric or calibrate another quantitative climate risk metric that's not directly linked to the stress testing. If we look on the in terms of how they're using it in credit decisioning, while a few may have hardwired decisions associated with the climate stress testing outputs, most firms are rather using it either as an information point for the RMs and the frontline where it is being used, or as an input into another metric, whether that's an ESG risk score. On the net zero side that you specifically called out, Constance, here we are seeing people more and more try and link the analysis they're doing on the emissions side with the potential change in credit risk associated with those scenarios. I think one of the challenges that people are facing is they've developed their climate risk stress testing models typically on an NGFS scenario set, whereas on the net zero target setting side, they've typically used IEA scenarios or other scenarios to set those pathways. But we are seeing more and more firms enhance the capabilities that they do have with respect to the scenarios they put through their climate stress testing infrastructure to support them to apply that risk lens at the same time as doing their net zero scenario analysis. If we maybe look forward, how do we see this changing? And this is one of the things we sort of questioned the survey participants as part of this report. And I think we are seeing growing appetite for firms to begin to use the stress testing output more in anger. So 2/3 of participants said that they're planning in the next 2 years to begin to use this for credit decisioning and for planning purposes. And if we sort of look at the regulatory agenda, that is now far more focused on embedding, and both the credit decisioning, pricing and strategic planning are areas that they've specifically called out, in addition to IFRS 9 provisioning, as areas where they think that banks should be leveraging this output. But I think there are a number of challenges, and a lot of these I think were mentioned by Mark when he was sharing his perspective. So data understanding of the transmission mechanisms, understanding of the sort of the frontline staff and staff outside of the climate stress testing teams or the climate risk or sustainability teams, who ultimately are the people who need to be using this for decision making, getting their sort of the maturity of their understanding up to the level required to use this properly, to inform it. And then also compatibility with existing processes. That means even in the long term, it may be that certain other types of metrics or scores or tooling might be more appropriate than scenario analysis. But even in those cases, I think we're seeing strong appetite from banks to really make sure that the scenario analysis and the stress testing they're doing is informing it once some of these challenges have been overcome. I don't know, Radka, if there's anything you'd want to add.
I think that as I said, and I think that also what Emilio mentioned beforehand is overarching. It's not just a stress test. It's not an adverse scenario. It's not a stress test. It is really enabler, and it's also going to find its way in the entire bank. Of course, there are some questions of when exactly things are going to end up. I think that there are also a couple of questions in the chat on that, in models, etc. But I think that overall the sensitivity analysis is providing us with so much information, and also the impacts coming out of a climate change, that this is of course going to be in the future instrument very relevant for the different structures and also lines within the bank.
Thanks very much for that. So I think that's given a very good insight into the potential internal future uses of climate risk stress tests. And certainly, obviously, there's a lot of challenges which we highlight in the report. They're going to have to be addressed before that credit decisioning really comes into play. I'd like to turn back quickly now to Martina, with your ECB hat on this time, and get, obviously, you know, the next big thing on the horizon that banks are looking at, aside from some of the ECB expectations, was, as Mark mentioned, this Fit for 55 exercise. It'd be really useful to understand from you. So the Fit for 55 exercise, just to explain, is where the Commission has mandated all 3 ESAs to test the resilience of the financial sector against the EU's goals to cut greenhouse gas emissions by 55% by 2030. So obviously it's addressed the EBA, but given that ECB had such a pivotal role or was central to their own stress test in 2022, I think industry very much expects that you will play a role in this exercise as well. So it'd be interesting just to hear from you on how you're looking to feed into that and what your expectations are there. Thank you.
Sure. Indeed, the ECB has developed quite some experience on climate stress testing with the supervisory 2022 climate stress test, but also with 2 top-down climate stress tests that we run in financial stability, one in 2021 and one this year. We published some preliminary results in the financial stability review in May, and a report is coming in the next month or so. Regarding a Fit for 55 exercise, that's indeed our next climate stress test that we are planning. The plan is not coming from us, it's a mandate for the Commission that is actually targeting the ESAs, but also the ECB and ESRB, asking for a strong collaboration, because this stress test will not be an individual sectoral stress test. It will not focus only on banks, insurance, on funds. It should include also cross-sectoral interactions and second-round effects. So here we really need to cooperate. Of course, the ESAs have expertise in the specific domains, but from the ECB perspective, we really need to contribute with also these more high-level considerations on cross-sectoral interactions. And the governance of the exercise is still for discussion in the details, in the sense, but what is the first step that we are now facing is the development of the scenarios. The Commission in the mandate already clarified that what they want to test is 2 adverse scenarios against a baseline where the package is implemented smoothly in the standard macroeconomic environment as currently forecasted. And so the discussion that we are now having together with the ESAs and also inside the ECB is how to design these two scenarios. There we have a clear guidance. So the first scenario should focus on adverse shocks that are coming from the materialization of climate risk, most likely in the form of asset price correction that are triggered by the reassessment of transition and physical risk in the market. So the adversity will come from climate shocks. While in a second scenario, we will need to combine these climate shocks also with additional stress, what's called other stress, that is the stress that is standardly tested in EU-wide stress test. So first phase of the work would be indeed to develop the scenarios, then we will have to run the individual sectoral exercise and also a cross-sectoral component of the exercise where all the modules fit together in an harmonious way and allow us to draw some conclusions that take into account also this interaction across sectors.
Okay. Thank you very much for that, Martina. That's very helpful, useful insight for us to take away on your role there. So I think we're now coming to some Q&As. There were a few Q&As originally for Martina in terms of the scenarios. One of those questions was around nature and whether that will feature as part of the NGFS scenarios that we're expecting in the later this year.
So first of all, the NGFS has a task force that is focusing on biodiversity loss and nature-related risks. They have a work plan 2022 to 2024 with different elements in the mandate. A key one is the development of a conceptual framework to include the nature-related consideration in terms of potential risk stemming from their transmission channels, taking stock of what has already been done and what should indeed be analyzed in the coming years. But also another element is of another objective of this task force is to provide recommendations to the other workstream of NGFS on how to integrate nature-related risk in their current work plans. And so I guess this recommendation will target also the NGFS workstream on scenarios. So there we will cooperate with them as soon as they're ready to share their insights on this topic.
Thank you. And just obviously in relation to our own survey of members, the majority of members do foresee kind of integrating nature into their climate risk stress testing or as part of it in the next couple of years. But obviously that will very much depend upon the progress made at the NGFS and the Task Force for Nature-related Disclosure. Moving on to another question we've received, which is, do you see climate stress tests being incorporated into solvency stress tests in the short or medium term? I'd probably give Martina a bit of a break and just ask if there's anyone from any of the other panelists that'd be keen to pick that question up.
Maybe I can provide our view on that. We want to avoid having a supervisory stress testing that is split in two between supervisory stress test as it used to be and new topics that would be in a separate supervisory exercise, because more and more scenario design will ask to handle both, as I said, macroeconomic variables, but also a wider range of variables to cover these new risks. So it will be very difficult to have not only climate or only a biodiversity scenario. When you design a relevant climate or biodiversity scenario, mechanically, you embark in it what it will mean globally for the economy, and so you handle macroeconomic variables, and so splitting will be impossible. And so we strongly, when obviously the framework is ready, we strongly favor having consistent stress testing exercises that combine traditional macroeconomic solvency analysis with these new risk factors. It's a challenge, both for supervisors and for banks, obviously, but having two parallel frameworks would lead to really difficult to explain and to handle frameworks.
Good points there. I think also one interesting thing that we did pick up, and I think you might have even highlighted this to us when we're discussing, Mark, is that the HKMA is planning to do include it in their include climate risk in their solvency stress test this year. So it'd be interesting to see what results come out of that, and if any lessons can be drawn from it more broadly for Europe.
It will be the first one of that kind.
Yeah. Any other comments from the participants on that question?
Yeah, I mean, I fully agree with Mark. That is the expectations to go in that direction. Of course, it will take time. I mean, we need to let's say it's a learning curve, and I mean we will have the next stress test, regulatory one and the internal ones to keep learning on these.
Yeah, thank you, Emilio. Martin, I think another question for you is, sorry, I'm not sure if this one's going to be right. It's probably too early. I think there was a question around the Fit for 55 exercise requiring ad hoc data submissions from supervised entities. I think that's probably, I don't know if you can say anything on that yet already.
Yeah, not at this stage.
Didn't think so, sorry. Are there any regulatory stress tests planned with concrete? Oh, sorry, I'm just doing a bad job of moderating here. Let me see if there's some others.
But maybe I think that let us look shortly on this question. I think that we have discussed this already. I think that we have the upcoming Fit for 55 exercise, and there are some plans, of course, coming from the EBA by end of the year, which were already published in the Sustainable Finance Roadmap. Therefore, I think that there is information coming up by end of the year on how climate risk stress tests are going to evolve, both for supervisory regimes, but also for the industry. And of course, we have the Fit for 55 next year. And maybe to touch on that, Constance, if it's fine for you, one of the questions is also if participants can offer a view on the learning curve for banks and how well leadership in Europe is being cascaded to other jurisdictions. Is the will of a bank enough, or is it a supervisory mandate critical? I would say, I think, at least from my perspective, as I felt during the interview process, it started as a learning exercise, but of course, I think it's a risk view of tackling a relevant risk for the banks. So therefore, the ambition is there, and I think that I would not say that it's supervisory mandate critical. I would just say that it is needed that we work all together with the industry and with the supervisors, because the question will not be tackled solely by Europe or the European banks or European supervisors. It should be solved globally, and therefore I'm really thankful for the NGFS work which is currently done, because we just need to work on this together. This will be my take on that.
Yeah, I'd say the regulatory action in sort of the UK and Europe has been a massive accelerator, and the banks in those two jurisdictions are ahead of peers in across other jurisdictions, including those that are fairly developed. But I think there are sort of non-regulatory pressures here that are forcing banks where there isn't the same supervisory agenda to develop scenario analysis and stress testing capabilities, and things like voluntary disclosure initiatives where their stakeholders are putting a lot of pressure on them to sign up, whether that's the investors or other groups, has meant that they are, without that supervisory pressure, looking at sort of the European and the UK leaders, and looking to develop in a fast follower fashion similar capabilities. Though I think that some of the challenges that have been sort of described here are exacerbated in those jurisdictions where there hasn't been the same regulatory push, because you also see those jurisdictions as that have the regulatory push as the ones that have the better data. A lot of the scenario work is providing more granularity than maybe you'll see in certain other jurisdictions, but there is still that will to be fast followers.
Great, well, thank you very much for that. I think we're coming to the end of the session. I just want to offer members of the panel, first of all, thank you very much for taking part. Are there any final reflections in a short quick fire round that you wanted to say before we bring this to an end?
I think no, maybe just a comment. I think it's already being said that is very important in this learning curve to work together. I mean, between industry and supervisors. So I think this will be key.
Yeah, absolutely.
And also from an NGFS perspective, just an echo to what Emilio said, we are really looking forward to receiving feedback from the users as much as possible. We have launched recently a user survey exactly for this reason, to understand what are the priorities, what we can do in the next 2 years to support the work of the banks, the central banks, and the supervisors in this process. So we are trying to engage a lot with users via outreach session, but also trying to get their feedback in order to shape our plans.
Indeed. Well, thank you very much for that, Martina. It's been great to have you here as well today, providing your insight, and we really look forward to, well, first of all, we hope the report is useful to you and your colleagues, and we really look forward to engaging with you as this process develops going forward. But otherwise, I'd just like to say to everyone, thank you for joining the webinar today, and for all the insights that have come through and your questions. I'm sorry if we didn't get around to everyone, but I hope it's proved useful for you, and we look forward to hearing from you and engaging with you all more on this topic as it goes forward. So thanks, everyone.
Thank you.
Thank you.
Bye-bye.
Thank you. Bye-bye.
Thank you. Bye.